Now we're going to start back with Chapter 2, our transaction analysis, and at this point we are now looking at learning objective 5, how to record and journalize and post transactions. So first, a journal is in chronological order, date order, so make sure you know that. That can be tested, and there's 3 steps. First, we want to find the account that is affected. I would mostly start with cash. Most students find cash quite easy to know if it's increasing or decreasing. And you'll remember from our previous lecture, the T accounts, remember debits are on the left and credits are on the right, and we went through the entire accounting equation and which side increases what. Once you know the account, then you need to determine that increase or decrease. So your T accounts will either be an increase on the debit or an increase on the credit. So this side is an increase on the debit and this side is an increase on the credit. And then once you know that, we record the journal. So that's our 3 steps. This is exactly how a journal entry looks. So this is a journal entry template. You should have this in Excel. This will help you when you are creating journal entries, and it will help you with your homework. Notice the date is on this side. Then you have the account and the explanation. Usually you'll enter an account here, let's say cash, and then maybe common stock, and then you'll enter a brief to record issuance of stock, let's assume. And then your debits will be on this side, and your credits will be on this side. And then notice the T account shape. So if you see, we have cash, accounts payable, and common stock. So these are individuals. So basically everything is all in a ledger, or what we call a general ledger. Then you'll see cash is a particular asset account, accounts payable is a particular liability account, common stock. For example, you may also have accounts receivable, you may have inventory. For accounts payable, you may have notes payable, maybe wages payable. For common stock, you might have preferred stock, additional paid in capital. Those are all the individual accounts that might be in the ledger. So when you are taking information, what you do is you post the journal entry, JE journal entry. So here is our $50,000 example, and exactly as we did cash, common stock, our $50,000, and here is our explanation, issued common stock. So this is the journal entry format. Then when we're posting it to our T accounts, you'll see here you have cash, so this increases on the debit and decreases on the credit because it's an asset. And then common stock is an equity account, and that increases on the credit and decreases on the debit. And remember, debits equal credits and assets equal liabilities plus owner's equity. So our asset here is an increase, and our common stock here is an increase, and here is our debit, and here is our credit. And then you see that on there as well. So how does the information flow? Well, first a transaction occurs, you analyze it, you enter it in the journal, and then you post it. So analysis, entry, and posting. Now if we go through our same Freddy's Auto Service example, and we go through it from an accounting equation, assets equals liabilities plus owner's equity, then we have our journal entry format. Make sure this is in Excel, and then your T accounts. Normally there are 2 accounts in a journal entry. There might be more, but at least minimal 2, because your debits have to equal your credits. And so if we see it now all together, you see each piece and how it's done. Notice the little 1 here is basically to kind of help us follow the transactions in the T account. Now when you do the same thing for cash, you have your $40,000 in assets and land. Notice everything is on our asset side of the equation. So this is a debit and a credit to an asset. So here we're debiting land for 40, we are crediting cash for 40 because we used it, and now you'll see you have right here the $50,000 in cash from previous, and now on the credit side you have $40,000 cash. Now we move to our third example where we purchase supplies, and here it's on account, so there is no impact on cash. but we did purchase it on account. So $3,700 of supplies is an asset, $3,700 is our liability. So here's our debit to supplies, our credit to accounts payable, and the posting of the T account. Notice these two accounts don't have a previous balance. So for performing services for clients and received cash of $7,000, notice how we've expanded the accounting equation to include revenues. So we get $7,000 cash, and then we get $7,000 of revenue. And remember, cash increases on the debit, and revenues increase on the credit. So this is our debits and credits matching. And now you see cash and service revenue. So right now, here we see that we have our $7,000, and notice our cash entries keep going. And if you look at our service revenue entry, you'll see it there for $7,000. Now, when we perform services for a customer on account for $3,000, no impact on cash. So we do have $3,000 in asset because we're going to get an accounts receivable as our debit, and our credit is service revenue. And when we post those in the T accounts, we see them here, and notice this is our second revenue entry right underneath, and it's on the credit side because revenues increase on the credit, decrease on the debit, and accounts receivable increase on the debit and decrease on the credit. Now we paid cash expenses, so this is easy, it's telling us, so we know cash is going down, and the various expenses we paid. So again, we're expanding our accounting equation to include assets, and we're doing it in total. But when we actually book the entry, as you see here, we separate it out: rent expense, salary, utilities, showing the cash. And then when you actually do the T accounts, our cash continues in this case, and here you see the $2,700, and you see all of the transactions on this end that make the different expenses. And remember, expenses increase on the debit side. Now we have $1,900 on the accounts payable created that we did in transaction 3. Now we're paying it, so our cash is going down. That's relatively easy. But our accounts payable, which is a liability, is going down. So in this case, you see here our cash, and then here's the $3,700 that we incurred. So now we have the $1,900 to leave our balance in there. When we receive $1,000 on account, we have increase in cash and decrease in our accounts receivable. So cash is debited, accounts receivable is credited. And here you see the transactions. Now we're just adding to the debits and we're adding to the credits. So with the sale of the land for cash of $22,000, now we know cash is increasing, so that's our debit. And land is, we sold it, so that's our credit. We're decreasing the asset. So you see the calculation here, and then you see the credit on the land side. When we declared and paid a dividend to the shareholders of $2,100, cash is going down for $2,100, and our dividends, and remember, dividends increase on the debit side, and they decrease on the credit side. So since we paid cash, here is our just keep going down in the debits and the credits for cash as a credit, and then our debit is to dividends. So once you do all of these accounts, then you post them to the general ledger, and now all of the accounts will be in this format, and this is the format that you can use to prepare your financial statements. And recall, we prepare the income statement, then we prepare the statement of retained earnings, we move on to the balance sheet, and lastly we prepare our statement of cash flows, and we do that in this order. So then after you post to the ledger, all of your accounts look like this. So here, let's stop at this point and go over exactly what we did previously. So in this case now, we purchased supplies on account for $5,000, and then we paid $1,400 on account. So we want to journalize both transactions. So we have a debit of $5,000 to cash, to supplies, and then we have accounts payable because we owe it. And remember, accounts payable are to vendors. So that would be a liability. And then once we pay it, notice we're not hitting supplies again. We are actually reducing our accounts payable, our debit and our credit. So our T account for accounts payable will show a debit of credit of $5,000, and then our debit of $1,400 to net to our $3,600 balance. Now, when we see it all here, you'll see how every transaction, in a much prettier format, obviously, supplies is the debit, and accounts payable and accounts and cash. So remember, supplies, cash increases on the debit and decreases. Supplies is an asset, so that too increases on the debit and decreases. But accounts payable is a liability, and that increases on the credit side and decreases on the debit side. So now what you owe is $3,600, and so far that's your balance. So you take the 5,000, subtract the 14, and make sure you put the transaction on the correct side. Accounts payable have a natural balance of a credit. Let's stop this video here.